Bitcoin just did something it hasn't done in months. In a single week, it tore upward by more than 20%. It smashed through the $70,000 level, kept climbing, and briefly touched almost $80,000 before settling back down. And somewhere in the middle of that chaos, a number that sounded almost laughable a few months ago quietly crawled back into the conversation. $500,000. I want you to sit with that for a second. Not because I'm telling you it's coming, not because I think you should mortgage your house and buy the dip, but because the question underneath that number is far more interesting than the number itself. Here's the problem with how most people are talking about this right now. Bitcoin doesn't actually need to reach $500,000 for this story to matter to you. The real question isn't whether Bitcoin can hit that number someday. The real question is whether the forces moving underneath this market right now, today, are strong enough to make a move of that size even mathematically plausible. In September, just days away, could give us the first real answer. Before we go any further, quick disclaimer, nothing in this video is financial advice. I'm not a licensed advisor, and this is not a recommendation to buy, sell, or hold anything. This is macro analysis and education, nothing more. Always do your own research and talk to a professional before making decisions with your money. Now, back to the story. There's one liquidity signal coming out of Washington right now, something most Bitcoin traders don't even glance at, that could end up mattering more than the Bitcoin chart itself. I'm not going to tell you what it is yet. Stay with me, because by the end of this video, you're going to understand exactly why that signal matters more than any candlestick on your screen. September isn't just another month on the calendar for Bitcoin. It's shaping up to be something closer to a stress test. Over the coming weeks, markets are going to be watching a pile of moving pieces all at once. Federal Reserve expectations, Treasury liquidity operations, exchange-traded fund flows, institutional positioning, the strength or weakness of the dollar, risk appetite across global markets, regulatory movement in Washington, and whether Bitcoin can actually hold onto the breakout it just fought for. So here's the question I want you thinking about while you watch this. If all of these pieces start lining up in Bitcoin's favor at the same time, how far could this cycle actually stretch? Drop your honest guess in the comments right now before you keep watching. I want to see what you think before we get into the data. And if you're the kind of person who wants macro reasoning instead of hype, instead of some influencer screaming a price target with zero explanation behind it, this channel is built for you. Subscribe to the Wealth Continuum because we're about to follow the money, step by step, all the way through this cycle. Let's slow down and actually unpack what just happened, because most coverage of this rally skipped straight past the mechanics. As of this Saturday, the 22nd of August, 2026, Bitcoin is trading somewhere in the neighborhood of $77,000 to $78,000. Just 1 week ago, it was sitting closer to $62,800. That's a weekly gain north of 20%, the strongest weekly move Bitcoin has put together since 2024. So what actually caused it? First, momentum. Once Bitcoin broke back above $70,000 for the first time since late May, it changed how every trader and every algorithm on the planet was positioned. Breakouts attract more buyers, and more buyers create more breakout. Second, short covering. When a market rips higher this fast, leveraged short positions get forced out. Billions of dollars in bearish crypto bets were liquidated over just a few days. Those forced buybacks don't just react to the rally, they actively fuel it. Third, the exchange-traded fund machine. United States spot Bitcoin ETFs pulled in over $1 billion in inflows in a single week. On one of the strongest days, BlackRock alone accounted for roughly 83% of a $606 million single-day inflow. That's not retail speculation. That's structural, recurring demand from wealth managers and institutions. And fourth, the piece almost nobody outside of macro circles is talking about. Liquidity. Bitcoin doesn't live in a vacuum. It never has. When liquidity conditions across the financial system loosen up, money doesn't just sit still. It moves toward risk. And that chain looks something like this. Liquidity expands, risk assets rally, and crypto, especially Bitcoin, often catches the tail end of that wave with the most force. But here's what they're not telling you in most of the headlines you've probably already scrolled past this week. Exchange-traded fund demand alone doesn't fully explain why this move could turn into something much bigger than a normal summer bounce. For that, we need to look at something most Bitcoin traders barely pay attention to: the United States Treasury. This is where the story stops being a crypto story and starts becoming a macro story. Stay with me here, because this is the part that actually explains the size of the move. The Treasury is not the Federal Reserve. They're different institutions with different tools, but Treasury operations can still shift liquidity conditions across the entire financial system, sometimes just as powerfully as anything the Fed does. This week, the Treasury announced plans to at least double its purchases of longer-dated government bonds. In plain English, that means buying back more long-term debt. which pushes long-term yields lower and puts pressure on the dollar to weaken. Analysts at firms like Bernstein pointed directly to this Treasury buyback move as the strong trigger behind Bitcoin's sudden rebound. Think about what that actually does mechanically. Lower yields on safe government debt make holding cash and bonds less attractive. A weaker dollar makes dollar-denominated risk assets more appealing to buyers both inside and outside the United States. And when those two forces combine, investors don't wait around for permission to start buying Bitcoin. They start rotating out of cash, into stocks, into higher beta assets, into crypto, and eventually into Bitcoin specifically because it sits at the far end of that risk spectrum. Here's a question for you, and I actually want you to answer this in the comments. Had you even heard about this Treasury bond buyback move before this week? Be honest. Most people hadn't, and that's exactly why it's worth understanding now, before the next headline catches everyone off guard again. This is where the Bitcoin story becomes a liquidity story. And liquidity stories tend to move much slower and much bigger than any single news headline about a price breakout. Now let's shift gears away from government liquidity and towards something just as important. Who is actually buying? Bitcoin has quietly gone through a structural transformation over the past couple of years, and most casual observers still haven't caught up to it. The old version of Bitcoin worked like this. Retail traders opened accounts on exchanges, speculated and moved in and out based on hype cycles and social media sentiment. The new version of Bitcoin looks completely different. Exchange-traded funds, financial advisors, institutional allocators, wealth management platforms, even slivers of retirement capital are starting to find their way in. So ask yourself this. What happens when Bitcoin stops being treated as some fringe, speculative side bet and instead becomes just another line item inside a diversified portfolio sitting next to stocks and bonds and real estate? And here's where the $500,000 argument actually starts to get interesting rather than sounding like pure fantasy. You don't need every investor on the planet to buy Bitcoin for that kind of number to become mathematically possible. You may only need a small percentage of some of the largest capital pools in the world to allocate even a tiny slice toward it. I'm not going to hand you the full calculation yet. Hold that thought, because we're about to walk through the actual math together, and I think it's going to surprise you either way, whether you're a believer or a skeptic. All right, let's actually do the math, because vague hype without numbers is exactly what gives this whole space a bad reputation. Bitcoin's total supply is capped at 21 million coins. As of today, roughly 19.8 million of those coins have already been mined, which puts us close to 94% of the total supply already in circulation. So let's use that circulating figure for illustration. If Bitcoin were trading at $500,000 per coin, with roughly 20 million coins in circulation by that point, you're looking at a total market capitalization of somewhere around $10 trillion. $10 trillion. Say that number out loud. It sounds enormous, almost absurd when you first hear it. But now compare it to the rest of the world's financial assets. Global gold markets alone are worth well into the double-digit trillions. Global equity markets are worth well over $100 trillion. Global bond markets are worth another 100 plus trillion. Add in global real estate, sovereign wealth funds, and retirement assets sitting inside pension systems around the world, and you're looking at a combined pool of capital measured not in trillions, but in the hundreds of trillions of dollars. So here's the big retention line I want you to remember from this entire video. The question isn't whether $10 trillion exists in the world. It absolutely does. The real question is whether Bitcoin can capture a meaningful enough slice of that ocean of capital to justify a valuation anywhere near that level. That's a completely different question than most headlines are asking, and it's the one that actually matters. Now, let's talk about where this $500,000 number even came from, because context matters here more than almost anywhere else in this video. Veteran trader Peter Brandt has discussed a potential Bitcoin cycle peak somewhere in the range of $300,000 to $500,000. But here's the part that gets lost every single time someone clips his comments for a thumbnail. His timing thesis stretches much further out across the broader cycle. It was never meant to imply a peak arriving by this September, or even necessarily this year. So when you hear the number 500,000 thrown around online, don't hear it as Bitcoin hits 500,000 next month. That's not what serious analysts are actually saying. Instead, hear it as this question. Can the current market cycle evolve into something structurally much larger than anything we've seen in prior cycles? That distinction is the difference between a credible thesis and pure clickbait. And honestly, that distinction is exactly why I wanted to build this video the way I have, walking through the actual mechanics instead of just throwing a number at you and hoping it goes viral. Here's where we get to the heart of this entire video. Stay with me, because the next few minutes are the most important part of everything we've covered so far. September needs to answer 5 separate questions before anyone can honestly say whether this rally has real staying power. Question 1. Does Bitcoin actually hold the breakout above $70,000? Or does it slip back below that level and trap the traders who bought the top? Question 2. Do exchange-traded fund inflows stay strong, or does last week's billion-dollar-plus inflow turn out to be a one-time spike? Question 3. Does broader liquidity keep improving, building on the Treasury's bond buyback move, or was that a temporary event? Question 4. Does the dollar keep weakening, creating a more favorable backdrop for Bitcoin, or does it stabilize and reverse? Question 5. Does the Federal Reserve become more accommodative? And here's something worth flagging honestly, because I'm not going to sugarcoat the data to make this story sound cleaner than it actually is. As of this week, market pricing through CME's FedWatch tool actually shows the odds of a Federal Reserve rate hike in September, rising above 40%, up from roughly 33% just a week earlier. That's not a typo, and it's not what most bullish crypto content wants you to hear right now. So here's a scenario worth thinking about. What if all 5 of those signals somehow look bullish on the surface and Bitcoin still falls anyway? That's not a hypothetical designed to scare you. That's a real risk hiding underneath this entire rally, and it's exactly where the biggest danger of September lives. What do you think happens? Comment below with your honest prediction. Does Bitcoin hold above $70,000 through the end of September, or do we see a pullback first? Well, I genuinely want to know what you're seeing in the charts on your end. I'm not going to turn this into another nonstop bullish crypto video, because you deserve better than that, and frankly, so does this channel's reputation. Here's what could still go wrong, and this is where it gets really concerning if you're only looking at the headlines and ignoring the risks underneath them. Profit taking after a 20% weekly move is completely normal, and it can hit hard and fast. Excess leverage tends to build right back up after every short squeeze, setting the stage for the next flush. Exchange-traded fund outflows could just as easily reverse the inflows we just talked about. A stronger dollar could return just as quickly as it weakened. Treasury yields could climb back up if bond markets react differently than expected. The Federal Reserve could disappoint markets that are hoping for accommodation, especially with rate hike odds already climbing. Broader recession fears haven't disappeared from the macro landscape. Geopolitical risk remains elevated, including ongoing tension involving Iran that's already been making headlines this week. And regulatory setbacks remain possible, especially with the Clarity Act, the crypto market structure bill President Trump has been pushing, currently stalled in the Senate ahead of a procedural vote scheduled for September. Here's the line I want you to remember from this section. A breakout isn't confirmation, it's just a possibility. The market has to prove it can actually hold the breakout before anyone should treat it as real. Let's run through this like a scoreboard, quickly, so you can weigh both sides for yourself instead of just taking my word for it. On the bullish side, exchange-traded fund inflows remain strong, with over $1 billion added in a single week. Liquidity conditions are improving thanks to the Treasury's bond buyback program. Institutional adoption keeps expanding beyond early adopters into mainstream wealth management. Political momentum is building around clearer crypto regulation. The dollar has weakened meaningfully over the past week, and declining available supply on exchanges continues to tighten the market. On the bearish side, Federal Reserve rate hike odds are actually climbing, not falling, heading into September. The dollar could stabilize or strengthen again. Treasury yields could reverse course. Leverage in the system tends to rebuild quickly after every squeeze. Macro recession risk and geopolitical tension both remain live threats, and the breakout still hasn't been fully confirmed with a successful retest. Right now, the market is telling us one story through the price action alone. But here's what they're not telling you just by looking at a chart. September is going to tell us whether that story is actually real or whether it was just a liquidity-driven sugar rush. Let's bring Bitcoin's supply mechanics into this picture, because this is the piece that could make September behave differently than previous rallies. Bitcoin's issuance schedule is predictable. New coins enter circulation on a fixed known schedule through mining rewards, and that number shrinks over time by design. But the truly critical variable isn't how many new coins get mined. It's how much of the existing supply is actually available and willing to be sold at current prices. Long-term holders, the investors who've held through multiple boom and bust cycles, tend to sit on their coins rather than sell into rallies. Coins moving into cold storage and institutional custody accounts effectively leave the liquid, tradable supply. Exchange-traded funds absorb coins and, in many cases, hold them for extended periods rather than actively trading them. And a growing number of corporations are adding Bitcoin to their treasury balance sheets, removing even more coins from circulation. So here's the mechanism worth understanding. If demand keeps rising while the liquid, sellable supply keeps shrinking, price doesn't need permission from anyone to move. Stay with me, because this next part is where September could genuinely look different from every previous Bitcoin rally you've watched play out. If institutional buyers keep absorbing coins at the same pace we've seen over just the past week, while long-term holders keep refusing to sell, the actual float The coins realistically available to be bought could keep shrinking at exactly the moment demand is accelerating. That combination, rising demand against shrinking float, is the setup that turns ordinary rallies into much bigger, much faster ones. Let's zoom out and picture the big capital pools driving this shift. Picture a pension fund quietly allocating even a tiny percentage of its portfolio toward Bitcoin exposure through a regulated exchange-traded fund. Picture a wealth management platform adding Bitcoin as a standard offering across client portfolios, the same way they'd offer exposure to gold or emerging markets. Picture institutional exchange-traded fund allocations creeping upward, quarter after quarter, the way we've already seen with BlackRock's dominant share of recent inflows. Picture corporate treasuries continuing to add Bitcoin as a balance sheet asset, the way a growing list of public companies already have. None of these buyers need Bitcoin to reach $500,000 to justify their decision. They're not buying because they're chasing a price target on a chart. They're buying because they've concluded Bitcoin deserves a permanent place inside a properly diversified portfolio. Here's the killer line I want you to sit with. Speculators chase Bitcoin because they expect the price to rise. Institutions buy Bitcoin because they've decided they have to own some, regardless of short-term price movement. That distinction changes everything about the long-term demand story. Speculative demand comes and goes with sentiment. Structural demand tends to stick around through entire market cycles. Quick question, and I actually want your honest opinion here. Do you think institutions buying Bitcoin is a genuinely bullish long-term signal? Or do you think it just makes the market more correlated with traditional stocks and therefore more exposed to the same risks? Drop your take in the comments. I read every single one. Let's give this whole video some structure you can actually use going forward. Here are 3 realistic scenarios for how September could unfold. Scenario 1, the breakout scenario. Bitcoin holds above the $70,000 level. Exchange-traded fund demand remains strong. Liquidity keeps improving off the back of the Treasury's bond buyback program. Fed expectations become more supportive than current pricing suggests. Result, bullish continuation into the final quarter of the year. Scenario 2, the fake-out scenario. Bitcoin breaks higher initially, retail excitement floods back into the market, leverage builds up quickly across exchanges, and then exchange-traded fund demand quietly fades just as fast as it appeared. Result, a sharp, painful correction that traps late buyers. Scenario 3, and this is honestly the most exciting one to think through. Liquidity keeps improving, the dollar keeps weakening. The Federal Reserve, despite current rate hike odds, ends up surprising markets with a more accommodative tone. Institutional flows accelerate rather than plateau, and Bitcoin's available supply keeps tightening at the same time. If that combination actually lines up, that's the environment where the more aggressive long-term Bitcoin models genuinely start sounding less crazy than they do today. Which of these 3 scenarios do you think is most likely by the end of September? Comment your pick, scenario 1, 2, or 3, and let's see which one this comment section believes in the most. Let's finally answer the question this entire video was built around. I'm not going to tell you Bitcoin will hit $500,000. Anyone confidently promising you that outcome doesn't actually know any more than you do. Instead, ask a better question. Is $500,000 possible? Mathematically, yes. The pools of global capital large enough to justify a $10 trillion Bitcoin market exist right now, today, in the real world. Is it inevitable? Absolutely not. Getting there would require massive, sustained institutional adoption, stretching across years, not weeks. It would require sustained liquidity conditions, favorable to risk assets. It would require Bitcoin fully transitioning into a mainstream portfolio asset rather than a speculative side bet. It would require continued scarcity of the liquid, sellable supply. It would require a broadly favorable macro environment across multiple economic cycles. And it would require years of compounding demand, not a single explosive month. September will not decide whether Bitcoin eventually reaches $500,000. Let's be completely clear about that. But September could absolutely tell us whether the forces required for that kind of move are actually beginning to line up, or whether this entire rally was just another liquidity-driven head fake. Let's bring this all the way back together. Bitcoin's explosive move higher this week isn't proof that $500,000 is coming. It's something more useful than that. It's a test of liquidity, playing out through the Treasury's own operations, a test of institutional demand, playing out through exchange-traded fund inflows, a test of available supply, playing out through how much Bitcoin long-term holders are actually willing to sell, and above everything else, a test of whether Bitcoin is becoming an asset that the largest pools of capital in the world simply can't afford to ignore anymore. And here's the one number I'll personally be watching more closely than Bitcoin's raw price throughout September: exchange-traded fund flows. Because if that number keeps accelerating while liquidity conditions keep improving, this entire Bitcoin story could look dramatically different by the time this market cycle actually finishes playing out. So don't just stare at the price ticker every day. Watch the money moving behind it. because that's genuinely where the next major move is going to come from. Before you go, two quick things. First, tell me honestly, what are you doing while watching this video right now? Are you on your commute, winding down before bed, or actually watching your portfolio while I talk? And second, just for fun, how's the weather where you are today? I always find it interesting seeing how many different corners of the world end up watching these breakdowns together. If this video actually helped you understand what's happening underneath this Bitcoin rally, hit like right now. It genuinely helps this channel more than you'd think. Comment below with your honest prediction for where Bitcoin ends up by the close of September. Subscribe to the Wealth Continuum if you want more of this macro-driven, no-hype breakdowns of where the real money is actually moving. And if you know someone who keeps asking you whether they should buy Bitcoin right now, share this with them, because this video will explain the situation far better than any group chat argument ever could. I'll see you in the next one.